Hey, good afternoon, everybody. Thank you very much for joining us. My name is Chris Donovan. I'm hosting today's webinar with my colleague, Rob Livson, who is the VP of Sales with Lightspeed. I myself am also a sales associate. Today we have a guest speaker for our presentation. His name is Robert Green. He's our panelist for the day. And he will be taking you through today's webinar on tips for professional traders and getting ready to file 2021 tax returns. So just sit tight for another 2 minutes or so. We will be getting started at 4:30. So we do have a minute or two left here, and we're also going to give people an opportunity to join as well. So just sit tight, and we'll be off to the races in a minute here. Okay, everybody, we're going to go ahead and get started. So I just have to read a quick disclosure before we get started. And as Rob had mentioned, my colleague Rob, this webinar will be available to be viewed again. We do record our webinars, so we will post this on our website and our YouTube channel for you to watch at a later date. Robert, our panelist today, has been kind enough to offer to take a few questions at the end here if we do have time. So we will see how things are at 5:30 and where we stand. And in the event you don't get your question addressed today, you can also contact him as well. Will be sharing his contact info, so you can reach out to him if you need to. So without further ado, let me just get through this disclosure, and I will pass things off to our panelist. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security, derivative, and futures trading involves a substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed Financial Services Group LLC is not affiliated with these third-party market commentators, educators, or service providers. Data, information, and material content are provided for informational and educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lightspeed Financial Services Group LLC does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, or educators, or service providers, and any information used to execute any trading strategies are solely based on the independent analysis of the user. So thank you very much for sitting through that with me. Robert Green, I'm going to pass things off to you. I will be making you the presenter here. Just one moment. Okay, Robert, we are looking at your screen here. Looks clear and good. How's your mic sounding?
Good. I just want to minimize the. Okay. Thank you, Chris and Rob. Can you hear me okay?
Yes, you're coming through clearly.
Okay. Let's get going. Yeah. So tips for professional traders getting ready to file 2021 tax returns. We like to call them traders with trader tax status in the business of trading. They have more opportunity for benefits and a little more work with their tax return versus active investors who fall short of trader tax status. Now, there's information in today's webinar for both types of traders, those who cut the mustard, who qualify for trader tax status, and those who don't. And if you don't qualify this year, for this past year, 2021, maybe you will for 2022. So Chris read the disclaimer. So here's a current photo of me. I'm CEO of Green & Company, Inc., which owns greentradertax.com. I was founder and managing member of Green, Neuschwander Manning, LLC, the CPA firm that prepares tax returns for active traders. I just assigned my interest at the end of last year, and now I'm doing consults through Green & Company, Inc. And my partners took over the firm, and they're doing a great job, Darren Neuschwander and Adam Manning. If you need more help after today's session and you're eligible for trader tax status, you might be interested in GNM, Green, Neuschwander and Manning's tax compliance service. So you're going to want to speak with Darren Neuschwander or Adam Manning. If you want to consult to see if you qualify, you can do that with me or with them. So we are not affiliated with Lightspeed Financial Services. Here's a Circular 230 tax statement. Today's information is educational. If you need help, get a one-on-one consultation with me, Darren, or Adam. So I had hoped Darren would join us today, but he was a little under the weather. So we're going to have insights and information on how to help traders file. So you're going to learn how traders who are eligible for trader tax status, TTS, they can maximize business expenses. Investors can only deduct margin interest and maybe borrow fees as an itemized deduction, which could trigger AMT. That's for the birds. Now, commissions are part of your trading gain or loss, so those are deducted against your capital gains. But business traders get a whole assortment of business expenses. Plus, they can make vital tax elections like 475 to be exempt from those onerous wash sale rules and get a QBI deduction, maybe 20% of their income on 100,000, deduct 20. Avoid the capital loss limitation. It's a great benefit, section 475, but you got to be a business trader and you had to make the election on time. And then you could also utilize pass-through entities like S-Corps partnerships for further tax benefits. To deduct health and retirement, you need earned income. So you need an S-Corp to pay your salary before year end. Hopefully you did that in December 2021. Now, sole proprietors can get that qualified business QBI deduction, but the S-Corp is even better because they can use the phase out with the wages. If you have a big loss, there's the excess business loss, the EBL. And then if it's excess, it becomes an NOL, net operating loss. There's no net operating loss carrybacks for 2021. You can only carry it forward. So if you're a business trader for 2021, you got a Schedule C for all your expenses. You can assess and claim it after the fact now. You can plan to do it the same way for 2022. If you didn't make the 475 election for 2021, you can make it for 2022. Most traders are good with just those two benefits. You can get QBI, you can get EBL, NOL. But if you want health and retirement, you need the S-Corp, and you might need a partnership for ring fencing. We're going to cover all that today. So you're going to learn all the various tax forms to use. It gets a little confusing. You got Schedule C for expenses, your gains are on other forms. The IRS can get confused about it. So you tie it together in your footnotes. So you're going to learn tips for filing extensions. It's hard to get your tax return together by April 18th, the deadline this year. The broker 1099s don't come out right away at the beginning of the year. They got to wait to the end of January to see about the wash sales. There could be corrected 1099s. Most traders file extensions, but you don't get an extension for making a payment. So you got to make a generous payment because you want to avoid that late filing penalty. The late payment penalty is not as bad. We're going to talk about tips for extensions. We're going to talk about common errors that some local accountants even make, or traders who self-file. Some things that seem intuitive, like putting trading gains and losses on Schedule C, is like almost a guaranteed audit and is a complete no-no. So you don't want to mess up. You don't want to botch your return. You want to file things properly. And then lastly, we'll talk about the latest tax legislation, how it impacts traders. You had the Tax Cuts and Jobs Act from 2017, took effect in 2018. Then the CARES Act came in there with the emergency pandemic relief and said, no, wait a second, these TCJA rules, we're going to suspend them for 18, 19, and 20. But they all went away. CARES doesn't apply to 2021. So you're back with the Tax Cuts and Jobs Act, no NOL carrybacks, and the limited NOL carry forwards, the EBL limitation. So all these tax changes have been confusing. We always wait until year end. What else do we have to put in our guide? Do we have to cover Build Back Better? But that never passed, so we didn't have to add that to the guide. That was a good thing. So let's start with the trader tax return reporting strategies. Traders use various tax forms. Gains and losses go on 8949, 6781, 4797, Schedule 1. Depending on what you trade, it goes on a different form. Your portfolio income, interest, and dividends go on Schedule B. Your business expenses go on Schedule C. It can look, your Schedule C looks like a losing business. All the income's on other forms. So it's very confusing to taxpayers. Now, if you use an entity, it can all be consolidated on the entity return. So when I say a sole proprietor trading business, what that means is we look back and we say you qualified, you're eligible for trader tax status for 2021. So you're a sole proprietor. You add a Schedule C for a mom and pop business, profit or loss from business. So trader tax status, a term that we coined, TTS, constitutes business expense treatment, and it unlocks an assortment of meaningful tax benefits that act for active traders who qualify. The first step is to determine eligibility. It's sort of like undergraduate college. You go online, you're self-taught, you see how you did, you grade your own papers, and if you think you qualify, you graduate, you have a diploma. If you want to go to grad school, Section 475, you got to apply to that on time. If you graduate undergrad TTS, then you must go to grad school to 475. If you don't apply to 475, you can't use it. So TTS is assessed and claimed after the fact, but 475, you have to elect on time, and it's conditional on having the TTS. So if you do qualify for TTS, you can claim some tax breaks such as business expense treatment after the fact and elect and set up other breaks like the 475 election, which you have to do in advance. This year it's by April 18th. Last year it was May 17th. And if you want the employee benefit deductions, health and retirement, which is based on TTS, you got to set up your entity. So the bottom line is that we can claim the business expenses after the fact, but if you want the 475 mark-to-market accounting, the tax loss insurance, and the QBI deduction, you had to elect it on time. If you want those AGI deductions for health and retirement, you had to set up your entity on time. So do what you can for 2021 and set up things better for 2022. So let's take a look at this, how to qualify. So let's make it a little bigger there. So the IRS rules are very unclear. Substantial, regular, frequent, continuous, catch swings in the daily market movements. Day traders are catching daily market movements, but so are swing traders. That's not enough. So we come out with our golden rules. We want to see volume of 60 trades a month, 15 a week. Frequency, we want to see 4 days a week, 4 of 5 on securities, over 75% holding period, less than 31 days. Full-time, part-time is fine. Spend 4 hours a day. Avoid too many sporadic lapses where you don't trade. Intention to run a business. Serious operations with a lot of equipment. Account size, patent day trader. 15, even if you're not a patent day trader, if you go below that, we think it's not enough to impress the IRS. If you use an outside developed ATS, automated trading system, that someone else wrote the code for, that doesn't qualify. You got to be in the cockpit, flying the plane, using automation and manual controls, but you have to self-create the automation. Trade copying service doesn't count. An outside money manager doesn't count. So sole proprietors, most sole proprietors, like your mom and pop business, if you have a Amazon store, or if you're a software consultant or an IT executive, self-employed, you have revenue and expenses on Schedule C. If you're an inventory business, you have cost of goods sold too. Throw that out the window for a trading business, which is upside down for many accountants. They don't quite understand it. It's only business expenses on the Schedule C. You're not really in a business per se. Your expenses are business expenses, but your income is capital from buying and selling capital assets. It may be ordinary with Section 475, but it's buying and selling capital assets. That has a big effect on state tax law. So it's important to understand really what you're dealing with. your trading gains and losses are going on other forms, not on Schedule C. Now, if it's a trading business entity with TTS, the entity has to qualify for TTS, and you have 475, it all ends up as ordinary in box 1. It looks a lot cleaner. You don't have stuff all over the place. Your individual return is nice and clean after it gets at Schedule K1. So let's say you sell securities. There's different forms for different financial products, securities, your equity options. It's the realization method. You don't have a taxable gain until you realize it, until you sell it. You're not paying taxes on your unrealized gains and losses at year end. Goes on Form 8949, which kind of matches up well with your 1099B. There's proceeds, cost basis, and then there's wash sale adjustments, and that's the scourge for traders. It's a real pain in the neck. If there's a loss on Schedule D, net of short-term and long-term, if there's a loss of 20,000, it's limited to 3,000 against other income, and then you have a 17,000 capital loss carryover, which you can apply unlimited against capital gains in the next year. It's only, the limitation of 3,000 is only against other income, not capital gains. So you're going to get a 1099B. Some brokers give an 8949. It can get very confusing on wash sales. Read our content about that. So wash sales on securities confuse taxpayers, and traders have many wash sales. Let's say you don't have any IRA and you have one trading account and you only trade equities. And you buy and sell, day trade just Apple and Tesla every day of the year. And you have a lot of wash sales. So you have wash sales that you go from January to February to March, and you keep doing it through the end of December, and you sell at the end of December, and you say, I'm not buying back anything in January. I'm going to trade futures in January, or not Apple and Tesla. You broke the chain on the wash sales. There are no wash sales a year, and I don't care about wash sales from January to February. I care about it from December to January. So you want to see where you stand and you want to break the chain. You still have some days left in January to avoid wash sales. You might have triggered some big ones already from January 1st until today, which is January 12th. So you want to know how to avoid wash sales. Now there's further confusion because the wash sale rules for brokers differ from the wash sale rules for taxpayers. That's an ugly truth that's widely misunderstood and conveniently ignored. So brokers calculate wash sales on the one account based on the identical symbol. But the IRS wants you to do it across all your accounts, including your IRAs, on substantially identical positions, which means between the equity and the equity option and the option at the different expiration date. So the wash sales on your 1099B, those are a narrow view for brokers. You can't expect two brokers to communicate about wash sales. You can't expect brokers to do it across all accounts or on substantially identical positions. There's only so much you can squeeze out of a broker to help the IRS police wash sales. So a lot of taxpayers think they're gaming the system. They take a big loss in December, an Exxon, and they say, I'm going to buy it back in my IRA or my spouse's IRA on a married filing joint in January within 31 days. I'll game the system. I'll buy it back in my Roth, and I'll get the snapback rally tax-free for life. Well, if you get audited and the IRS has a tool to catch you, and there's very few tools to do it, they could bust you on that. So if you want, you can use software like TradeLog to do it according to taxpayer rules for taxpayers, or you could stick with the rules for brokers. So that's a whole other world of potential confusion. When you see that whopping number for disallowed wash sales on the 1099B, don't freak out, because you may have already picked that up in your cost basis. So every time you have a wash sale, it defers the loss to the next position's cost basis. You could have $1 million of deferred wash sales for the year on the 1099B, but have zero wash sales open at year end because all those wash sales were sold by the end of December in the cost basis number, and they weren't bought back in January. So the IRS, so the broker didn't defer it to the January position. It was all in that cost basis number. So when you do the math, proceeds, cost basis, wash sales, it comes out to a number without wash sales because you absorb them all. They so-called came out in the wash. So don't get too confused. Use the software. You certainly don't want someone to botch this area. So now here's a note about cost basis adjustments on the 8949. If you traded commodities ETFs like USO, they're publicly traded partnerships. You get an annual schedule K1, which might pass through some 1256 treatment where you get the lowest 60/40 rates. So even though when you sell the ETF, it's a sale of a security, and the broker 1099 will pick that up. It's like selling a securities ETF or a stock or an equity option. It's the realization method. It's a security. It's a widely held security. But you might get a K1 at year end. And what the heck do you do with that? Well, there might be some pass-through income on that, which you're supposed to put on your tax return. But then you better adjust your cost basis form on 8949, because if you're picking up that income, $10,000 of income on your tax return, you want to add that income to your cost basis. The broker 1099B won't do that. The trade log software won't do it. You got to manually do that. Tell your accountant to do that. So if you sell a security, we just went over what you do in the cash basis. But if you have trader tax status, and you elected 475 by May 17 last year, there was the COVID 1 month delay from April 15th. And then if you were in Texas, Oklahoma, Louisiana, you had until June 15th to make that 475 election. Then you're not dealing with wash sales. Now, maybe you told your broker to use MTM. They really shouldn't do that because they don't know whether you qualify or made the election on time, but some might have done that. So you're basically ignoring the 1099B, and you got to do your own accounting with trade log because you're not subject to wash sales on your trades. You are on your investments. Now you still got line by line reporting. Your broker may say, I don't want to do line by line. Let's just do mark to market in a total sense. But you're supposed to do line by line. So you use trade log to do that. MTM, mark to market, means open business trades are marked to market at year end based on year end prices. You're imputing a sale at year end based on year end prices. You're basically treating it sort of like futures with realized plus unrealized gains or losses. What's nice about it is that makes wash sales a moot point. Now, if you have segregated investment positions inside your trading account or on other accounts, you can't use MTM on that. And if you have segregated investment positions in the same account as your trades, commingled for portfolio margining, you might have some havoc with the IRS trying to apply MTM to your investments. So you want to have separate accounts for that. And if you have significant segregated investments versus trading in the same positions, you may want an entity for ring fencing so you don't have problems going forward. So you put the MTM 475 on form 4797 part 2, and it has, so let's take a look quickly. Well, actually, we'll come back to some of the forms afterwards that I set aside in the browser. So form 4797 is sale of business property. Part 2 is ordinary gain or loss. What's nice about that? It goes right to the 1040 page 1 as ordinary income gain or loss. If you have a loss of 200,000, you deduct that whole 200 against your wages, and you might have a loss, or you may have very little income. That's really good. You're not going to be stuck with a 3,000 capital loss limitation. So no wash sales, no capital loss limitation. And if there's income and not too much of it, you'll get that qualified business income deduction. Now, let's say you traded futures, section 1256 contracts. Simple one-page 1099B, aggregate profit or loss goes to form 6781 part 1. One-line reporting, summary reporting, aggregate reporting. That breaks it down 60/40 and then goes over to Schedule D, 60% long-term, 40% short-term. You get that long-term capital gains rate benefit of 60%. The rates are 1/3 off. On our website in the 1256 page, it shows you the table. Instead of paying a 35% rate, you pay a 23% rate. So you have 12% tax rate reduction. That's huge. On $100,000, you save $12,000. The other nice thing about a 1256 loss, now with you losing on securities, you have a capital loss carryover. With losing on 475 securities, you have a loss the current year, and then you have an NOL carry forward. But with futures, whether you're a trader or not, you have a 1256 loss carryback election on Form 6781 Box D up top. You can carry back your 2021 futures loss 3 tax years, but it can only be done against futures gains. That's the only catch. It can't go against other capital gains and losses or other income, but you got to make that on a timely basis. So don't forget about that. Whatever doesn't carry back carries forward, so it's not wasted. Now, if you traded Forex, spot Forex in the interbank market, you're not treating it like futures or securities. It's line 8, other income or loss. It's ordinary, section 988. If you have TTS, it's Form 4797, so it's a business loss, so you don't waste any. It's a net operating loss. And if you did the capital gains election, you might have Form 6781. We probably don't have too many Forex traders on today's call. So the business expenses on Schedule C, it's only a loss. The IRS says, what kind of business is this? There's no revenue. There's $20,000 of expenses. You're asking us to go along with that? We think it's not a business. Well, you have a footnote that's going to explain that you're a profitable business, but you may want to use a transfer strategy that we advocate. It's not in the forms. We've used it since 1997. So what you say is, I'm going to take a portion of these trading gains on 8949. I'm going to transfer them to the other income line of Schedule C and explain it in the footnote. And that's going to unlock my Section 179 100% depreciation, and it's going to unlock the home office deduction, and it's going to get rid of the red flag. So Schedule C expenses, looks like a loss. Transfer some gains if you have them, explain it in the footnote, and that basically shuts the IRS computers down because they look at the page 1 of the 1040 and it's 0. They don't see any loss. Now, don't worry, if you don't do the transfer strategy, you can still unlock the 829 home office deduction by pointing that form to line 8, pointing your trading gains to line 8 on that form. So there's another way to unlock the home office deduction. We always have included footnotes. You got to make sure you can do that in TurboTax. Your local accountant can do that. I've always liked footnotes to nip questions in the bud. So if the IRS has a question, you anticipate them and you answer it. Now, some accountants don't like footnotes. They don't want to volunteer any information. But I don't want our clients to get audited in the first place. So I think you really need a good written footnote. So what kind of business expenses are we talking about? Your computer up to $2,500 is an expense. Your computer over $2,500 is Section 179 100% depreciation or 100% bonus depreciation. Your startup costs, you go back 6 months before your TTS started. Let's say your TTS started July 1st, 2021. You go back to January to pick up some of those courses that you took or software that you got or memberships that you paid for. Then you write off the first $5,000 up front. Your organization costs in the LLC. Your education expenses, those are your Section 195, your books, publications, market data, charting, online services, cloud, chat rooms, mentors, coaches, supplies, phone, internet, travel, meals, seminars, conferences, the works. Home office is a huge deduction. Your home office area is 10% of the home, 20% of the home. The home costs $20,000, $30,000. You write off that 10 or 20% of the home, including the real estate tax and mortgage interest, including the depreciation, your margin interest, your interest on trading capital. Stock borrow fees if you're a short seller. If you created your own ATS, automated trading system, self-created. Every dollar of expenses deductible. Could be $5, $10, $15, $20,000. That's some nice savings if you're in a decent tax bracket. Now, we don't go for vehicles. Every once in a while, a trader says, I want to get a luxury vehicle, huge monster depreciation. You're trading from home. You're not using that vehicle to do business. Your commissions, those are not separately stated expenses. Investors get those too. Those are part of trading capital gain or loss. Now, employee benefit deductions, health and retirement are huge, but they're not business expenses. They're AGI deductions, and the trader needs the S Corp to arrange those. Let's see how we're doing. Let's take a break for a second on time. I'm throwing a lot at you. There's a lot to cover. Go back and play the recording later. Slow it down for the area you want to focus on. Go back and look at the slides. The separate entity return, a lot of traders don't need an entity, but what's one of the things that's nice about it is that it consolidates your trading business. So it takes care of that income transfer, whole issue, and all the different forms. They're on that one trading business return. The IRS doesn't have to pick a needle out of the haystack of your individual return. So the 1065 of the partnership, the 1120S of the S Corp, you get the Schedule K1. It's a pass-through entity. It passes the income to your individual return where you still report all the income, gain or loss. Whether you take a distribution or not from the entity, you're taxed on the underlying income, but it focuses the whole business aspect to the return. Our firm can do your entity return, and you can do your own individual return. Now, let's say the pass-through business passes through a loss. IRS wants to say, oh, that's a passive loss activity. You can't take it. Wrong. The trading rule applies. The IRS doesn't want people with real estate passive loss activities to go out to a hedge fund to use it up. That's the trading rule exception. So the K1 breaks down everything from that partnership or S Corp return. There's portfolio income, there's capital gains and loss, there's ordinary income from the 475. The expenses are with that 475 on box 1. And then you very simply pick it up on your individual return. So the ordinary line has the business expenses and the 475. It looks better. So if you want the health and retirement, you're going to need the S Corp. The partnership can't do it. The sole proprietor can't do it because they don't have earned income. Qualified business income, that came out of the Tax Cuts and Jobs Act, makes the tax return a whole heck of a lot more complicated. People who used to self-prepare before just gave up on it. Those were CPA employment acts, and we didn't want all that work. Believe me, we've all had a surge in demand, and we have staffing issues across the industry like anyone else. We did great this year, G&M hiring 3 new CPAs, but there's a surge in demand, and one reason is because it is QBI. We fought to get 475 in QBI, and we got it. It's a service business, so there's limitations. So now Section 475, that's always been our bread and butter since 1997. It's a tax loss insurance, and now with the QBI, there's a benefit for the profitable traders too. So 475, you had to elect it. You got to have TTS and how to make the election, and it exempts you from the wash sales, exempts you from the capital loss, and it gives you a business loss that's an NOL. The excess business loss rules apply for 2021. The CARES Act, which put those aside for 18, 19, and 20, it brings it back. So if you have $1 million loss, you're going to have an EBL limitation. So the inflation adjusted limit is 524 married, 262K other taxpayers. So let's say you have a 300K loss for 2021. Your EBL is 262. The other 38,000 is going to be an NOL carry forward to 2022. There's no more NOL carry back under Tax Cuts and Jobs Act. So you may have an EBL limitation. You can look at on an aggregate basis, the EBL, and include wages in that as well. So you got to deal with EBL and NOL rules this year because of TCJA. So the CARES Act was wonderful. We slipped in some great losses for 2020, 2018, 2019. Traders are able to do the NOL carryback, get a huge whopping refund, keep the trading capital, stay in business. But then again, on the other hand, there weren't too many whopping losses for 2020 and 2021 with the COVID traders and the markets, which were an outlier. I've never seen anything like it in all my years, which are many years. There were a lot of gains. There weren't as many losses. 475 has always been a saving grace for traders, but maybe not as appreciated that much in prior years. Maybe it will be this year. If you have some big losses in Q1 and you're a TTS trader, you want to get in that election by April 18th so you have ordinary loss treatment. But you're going to have EBL and you're going to have NOL. Now back on the QBI deduction, which you might have for 2021. Let's say you're a sole proprietor trader. You don't make too much money. The way I like to explain it is if you make a huge cake, there's no icing on the cake. There's no QBI deduction. You made too much money. But if you made a bunch of little cupcakes, you're going to get your QBI deduction icing on the cake. So you're a sole proprietor trader. You made 100,000. Your taxable income is 80,000. It's the 20% deduction is on the lower of your 475 QBI income, net of your business expenses, or your taxable income after the standard deduction. So in this case, you're getting the 20% deduction on the 80,000. A 16,000 deduction is really nice. But if you make 300,000, you're making too much money for the QBI deduction. So the QBI threshold down at the bottom here for 2021 is 340K married, 170 other taxpayers single. So if you made 200,000 taxable income net, why did you make so much? Your trading gains were only 100, but you got your wages of 150. So you're priced out of it. But if you're a full-time trader, maybe you're not priced out of it. So you don't want to miss out on that QBI deduction. You might be throwing away a $20,000 deduction at a 35, 40% federal and state tax rate. Well, if you're in the top bracket, you're probably priced out of it. So figure in a lower bracket, 25% on 20,000, that's a nice savings, $5,000. So you don't want to throw away a deduction like that. So you want to go through all the ins and outs of it. It's on Form 8995 if you have the phase out 8995A. So you may need our help with that if you're QBI. Your local accountant may not even realize that QBI includes 475. It excludes your capital gains income. So your ticket to QBI, your ticket to tax loss insurance is 475. Here are the election procedures. Existing taxpayer individuals, that just means you filed a tax return in a prior year. If you're an 18-year-old kid, $1 million trader, crypto holder, and there are plenty of them now, but you never filed a tax return before, you're not an existing taxpayer. You were a new taxpayer, but most people are existing taxpayer individuals. If you qualify for TTS and want 475, you had to file a 475 election statement with the IRS for this next year, for 2022. You got to do it with your 2021 tax return by April 18th. It's too late to do it for 2021. You had to do it by May 17, 2021. Now, if you're an existing partnership or S Corp, that means you're filing a 2021 tax return for your partnership or S Corp. You got to do it by March 15th, 1 month earlier. If you're a new taxpayer, like a new entity, a new S Corp that's within 75 days of inception. So if you set up your entity March 1st, you have 75 days from inception to file it internally in your own books and records. When you're an existing taxpayer, you're filing it with the IRS, and then the second step is a 3115. So if you filed your 475 election for 2021, which was due May 17, 2021, then you need the second step to complete the process. You need to file a Form 3115 with your 2021 tax return. And you might need Green, Neuschwander, and Manning, G&M's help, Darren Neuschwander, Adam Manning's help on that Form 3115, the 481A adjustment. And if you have TTS and you need a 3115, you're a good fit for our service, and hopefully they will accept you for the Green, Neuschwander, and Manning service. So go to the tax compliance page on the Green Trader Tax website and read about it and ask for that service help to see if you're eligible for it. So tax treatment elections. You're a Forex trader. You got to do we'll come to that next. So first is the 475. We just went through that. The new taxpayers do it 75 days from inception. And if you're an existing taxpayer, you do it with the IRS and then the 3115. If you're a Forex trader, you want to consider the capital gains election for capital gain and loss treatment and to navigate into section 1256G, lower 60/40 tax treatment. All right, stop for a second and see how we're doing. We're coming along pretty good. Filing as an investor. So you've been on the webinar. You don't have trader tax status for 2021. You just don't cut the mustard. Maybe you did for November and December. That's not long enough. We want to see at least all of Q4. Maybe you did for June to year end. That's good enough. But the first part of the year, investor. The second part, you're not. You're a trader. Let's say you don't have TTS. You're an investor. Well, you still got to report all your trading gains and losses right. You still got to deal with all the wash sales right. You couldn't elect 475. If you did elect the 475 election, it's null and void, as if you didn't. You're not going to grad school for the 475. Your application is just ignored. You want to go in the future, you got to apply again. You don't have to file at 3115. It's just null and void. You file as an investor. Now, investors have suspended investment fees and expenses from the Tax Cuts and Jobs Act. Investment interest expense is allowed. That's margin interest. That's reported on Form 4952. It's limited to net investment income. So let's say you have margin interest at 10,000. Your interest income is 1,000, and then you have all capital losses. You're going to be limited to 1,000 and have to carry over the 9,000 to the next year, and it's an itemized deduction. You might be using the roughly doubled standard deduction instead. And so the excess margin interest expense is a carryover to subsequent years. It's on Schedule A. It's also deductible for the net investment tax on Form 8960. As investors, you got to deal with that SALT cap, $10,000. So that if you're in California or New York, you might use that up just for your real estate tax. What about all your state income tax? In New York City, your local income tax, all wasted. If you're a trader with trader tax status and a pass-through entity, you might have that SALT cap workaround strategy, which I've been covering on our blog all year. But the investor is totally disenfranchised from deducting their state and local taxes. Now, the House wanted to expand that cap to 80. The Senate didn't agree to the House bill. BBA, Build Back Better, is on the back burner now. It's still on the burner. The Senate may change how it does SALT, but the SALT cap workaround is still a great strategy. That's all up in the air. Many states don't even allow itemized deductions. Business expense treatment is just so much better than the investor expense treatment. All right. I've confused you, but in a worthwhile manner, because you're talking about some big breaks for this past year, 2021, and for this coming year, for this current year, 2022. So you get your act together, you figure out, you fool around with TurboTax, you work with your accountant, you work with Green, Neuschwander, and Manning, you get your gains and losses right, you get your status right, you get your general expenses right, and you come up with a draft tax return. And you say, okay, let's file an extension. So the income tax returns for individuals are due April 18th, because even though the 15th is on a Friday, the way all the holidays work, it's Patriots Day, whatever, it's the 18th, and it's even a little later from Massachusetts, but it's April 18th. Your broker may correct the 1099s, your K1s from your hedge funds and real estate partnerships and brother-in-law's business and your own business, they're coming late. So you're going to file an extension. You don't have to rush in a return that you then have to amend, totally messing up the IRS, who is so messed up already with COVID and everything is already delayed. Don't freak out and force your accountant to file. They'll fire you. And believe me, accountants have all the work they can deal with. Be prepared to file an extension based on good calculations and estimates. It's a simple one-page form, federal and state. Now, you're going to pay taxes with the extension. Traders can request the automatic 6-month extension of file, federal and state. A lot of states accept the federal extension. You only need a state extension if you owe money. Some they don't, so check your state rules. You're going to get automatically, there's no excuse needed. You're going to get an automatic extension until October 15th. You can do it over the phone, online, by mail, by fax. It's as easy as apple pie or whatever to file an extension. You better file that extension, even if you owe $100,000 and can't pay it. File the extension because that will exempt you from the late filing penalty, which is 5% a month, up to 5 months, 25%. You don't want to owe the IRS $100,000 and then a $25,000 penalty. You want to file that simple extension, no matter what you put on it, just get it filed and then have a late payment penalty of 0.5% a month. That's sort of like a low margin loan. So the late payment penalty, traders can deal with that. But the late filing penalty is a disaster. So get your plan right on these extensions. It's very simple to do and make life a little easier for your accountant, for yourself. Give yourself more time to get things right. Sometimes subsequent events like tomorrow's racing form helps you when you're betting on the horses the day before because you see the results. You see if you still have trader tax status. You see what your gains and losses are. You have a better idea, which gives you more help with your current return. Now, you may not owe a Q4 estimated tax payment next week. You might be able to save a lot of the tax money you pay until the April 18th. But I don't want you to lose. Then you may file an extension for 6 more months. So you may say to the IRS and your accountant, listen, I'm not paying Q4. I'm not paying April 18th. I'm keeping my money in the markets. I'm going to triple my money in the meantime. Then I'll square up with the IRS on April 15th. We've seen so many people over the years really get hurt with that strategy. They lose the money in the markets. They can't pay the IRS. They can't do an NOL carryback. In the old days, you could say, I owe you $200 for last year. I'm going to carry back my big loss to you get an NOL. Give me some time. You can't do that anymore. There's no NOL carrybacks. I think if you owe the IRS, you should pay Q4 what you owe with the safe harbor exception. So, and I have that in the current blog post that just came out this week. Traders should focus on Q4 estimated taxes. So let's say half of what you're going to owe, you're going to pay next week. The other half you can set aside to pay April 18 and then pay with the extension. We do not advocate holding on to the money to the last minute. It's irresponsible. It's too many people get into trouble over it. You shouldn't keep risking double or nothing the tax money owed the IRS. Salt cap workaround. You got that 10K salt cap on your individual return. The blue states, the high tax states, when TCJA came out and limited the $10,000 deduction, and the red states said, hey, why should we finance blue states, irresponsible government? We're limiting your deduction. The blue states say, when we get back our power, we're going to rectify it. Well, the states didn't wait. They came up with this workaround. And the IRS said, okay, to a business workaround. If you have a trading business in a partnership or S Corp, and you are going to owe $25,000 of taxes on your individual return from the pass-through income, the state said, hey, wait a second, just pay me that $25K on the business return. I'll then give you a credit on your individual return, and that's an effective workaround. So for someone in Connecticut, it's mandatory. In most other states, it's elective. So a lot of people who are used to filing a state extension with zero tax, a simple no-brainer, they're now paying a big check. And if you wanted the SALT cap workaround for 2021, you had to make the payment before year end 2021. You couldn't wait for the extension. So maybe you didn't quite get your act together on the SALT cap workaround for 2021, but you want to get it together for 2022. And let's see what happens with Build Back Better. California said if Congress repeals the SALT cap, they'll repeal their workaround, but I don't think they're going to repeal the SALT cap. They're going to expand it. And the workaround still really is good because even expanding it brings back AMT. So this is a work in progress, the SALT cap workaround. A lot of our traders got their act together to get $100,000 deductions if they're huge money makers. They may be paying California $100,000 of taxes on their trading income. With the workaround, they're going to get a deduction for that as opposed to a $10,000 deduction. So some common areas. Let's see how we're doing here, 520. So I covered that already. You go to your local accountant, you tell them you have TTS, they conflate it with 475. They didn't realize you had to go to grad school. They just say, okay, let's put the gains and losses on Schedule C. I don't know what to do with all this 1099B and wash sales. All I know is that your proceeds are 20 million and your cost basis is 19 million, nine, whatever. And okay, you made 100,000. Let's put it on Schedule C. Nice, intuitive, cutting the corner, but guaranteed audit or red flag notice with the IRS. You can't cut the corner like that. You got to go through all the reporting the way I said. The accountant says, oh, wait a second. We don't want TTS. We don't want 475. That's going to give you income on Schedule C and bring up self-employment tax 15.3%, FICA and Medicare on the Social Security base and the Medicare Unlimited. We don't want that, so let's skip the whole business. So you skip the business. Well, they were wrong. There is no self-employment income with trading. There is no Schedule C income. It's either zero with the transfer strategy or a loss. And even if it was you transfer too much, it wouldn't be SEI, but don't transfer too much. There is no SEI unless you're a member of a futures exchange trading futures on the exchange. Then it's Section 1402I, self-employment income. So the accountant said, oh, it's self-employment income. You're not a futures trader, you're a securities trader. They were wrong. And then they compounded. They say, oh, the good thing is that with self-employment income, okay, you pay some SE tax, but that unlocks the health and retirement plan deduction. And let's go crazy with a huge retirement plan deduction and do a backdoor IRA. It's all going down the wrong path, getting you into huge trouble with an excess contribution to the retirement plan, with FICA tax that you didn't owe. You can't deduct the health insurance. They did everything wrong and you got yourself in further trouble. Now, a lot of traders, they make a lot of money and they say, what is this net investment tax? The Affordable Care Act net investment tax, the 3.8% Medicare surtax on upper income taxpayers. So you make over 250 married, AGI 200 individual. So you're single, you make 300 trading, you're over the 200, you're 100 over, you pay the $3,800 of Medicare tax. Maybe you never saw that before. You might see it this year with huge gains. Playing around with virtual currency, cryptocurrency, the IRS is trying to catch up with you. They keep trying to change this every year, the questions. If you invested in cryptocurrencies and sold, exchanged, spend some during the year, you have a capital gain or loss to report. This includes crypto to current crypto trades. You trade Bitcoin for Ether, vice versa. You do crypto to fiat. All your crypto transactions, if you use it or sell it or of any kind, you got a realized event and you have to report it's intangible property. It's Form 8949. You probably got busted with letters from the IRS. They have a question on their return. Every year they revise the question. This year it's at any time during 21, did you receive, sell, exchange, otherwise dispose of any financial interest in a virtual currency? It's still not an FBAR report. All right, I think we did pretty good. We're at 524. So a lot of the stuff we talked about today is in Green's 2022 Trader Tax Guide. There's just a ton of information. One break alone covers the cost of the guide. It's $68, $68.95, but there's a 25% off coupon for you Lightspeed traders. The coupon is Lightspeed. You got to use it by January 24th. So just go to the website, click on the guide, put in the coupon, get that 25% off $17 savings. The guide is going to help you in so many ways. Everything we talked about in the long form, really take your time to read it carefully. Contact us at Green Trader Tax. Send in, if you had a brief question today, I won't get to all of them, send it to info@greentradertax.com. So you can come over to the website. So the Green Trader Tax website. So a couple of things is go to consulting under services. If it's really focused on tax compliance, TTS, all these things, how to handle your old 21, even if you don't want to sign up with us for 2021 tax compliance, you just want help with how do we do what Bob said? I'm doing my TurboTax. I just need a little help. Click here to purchase the consult with Darren Neuschwander and Adam Manning from Green Neuschwander and Manning. They will help you through all that, even if you don't use the tax compliance service. If you're focused on TTS and planning for the future and wanting an entity and all that, do the consultation with me through the Green Company store. Now come back to the Green Trader Tax website and you want tax compliance. You said, Bob, you told me enough to say this is over my head. I want to be a client of Green, Neuschwander, and Manning. So come over to services, tax compliance, read through what it looks like, have that consult with Darren or Adam, get them to accept you as a new client. We hired a lot of new people. They hired a lot of new people. I think they're ready to handle you. So earlier this year, we were overwhelmed with the surge in demand, but we've added capacity and we've opened the door to a limited number of clients who really need us. So the Tax Center has a lot of information as well. So here are some of the forms we talked about today. Schedule K1, you just 8949, 6781, 4797. So we'll come back to the website. And I'm not sure we have time for questions. Let's take a look. Hold on. Let's see if I can see the questions.
I can read them off for you.
Don't read them. You can make me an organizer, or I can't do the questions because I usually read them in short form and kind of get to it quickly rather
Got
than
it.
have you
Okay.
read
All right.
it
Yeah.
out.
Give me a second. Let me make you an organizer. All right. There you go.
Expense. No, commissions are part of your trading gain or loss. Everybody benefits, except if you have a capital loss limitation, you're going to have to defer it to the next year. The tax rates change? No, they're basically the same rates. The brackets changed a little bit with inflation, but the rates are basically the same. David G. I'm a customer, really appreciate you, Darren, and your team. I have qualified many years, had a 475. Golden rules. Yeah, same golden rules. So even though you don't elect 475 each year, 475 remains in effect as long as you have TTS. And each year we assess your TTS. You may be hitting all the numbers for last year, 2020, but 2021, you might have gone cold. So, and then we can't use 475. So glad you're working with us, David. I thought the wash sales are a good thing. No, they're a bad thing. Wash sales have the effect of deferring losses to the next year. You don't want to go to your accountant and say, I made 100. I'm ready to pay my taxes. And then the accountant says, well, wait a second. You have another 50,000 a wash sale deferral. You got to pay taxes on 150. What? I don't want to pay taxes on losses that were deferred to the next year and then have a capital loss limitation the next year. It's a disaster. So capital losses are really problematic and they're a scourge, and that's why we've always loved and advocated for 475 to be exempt from that whole morass. Sean J., could you please discuss more in depth both day trade, long-term positions, 475? That's a real big issue in this year's guide. You got a lot of people are options traders. They have FANG stocks, Apple, Microsoft, Tesla. They're long positions. They're nursing huge unrealized capital gains. They're going to have deferral at year end and then have a long-term capital gain. They trade options around those positions and they say, Bob, I don't want to trade naked options. I'm trading options on Tesla and Apple and Microsoft, my investment positions. I'm using portfolio margining so that I can squeeze every drop out of those positions to use that money to trade the options, covered calls, right to collect premium, risk on, risk off trades, insurance. I'm doing all that. Do I have TTS? Can I safely use 475? No, big problems to deal with here, folks. If you combine your Apple, Tesla, and Microsoft in the same account with your trades, the IRS can say you don't have trader tax status. The weighted average of those investment positions make you over 31-day average holding period, so you don't have TTS. Even if you then separate the accounts, losing portfolio margining, you can only do it in the same account, then you're going to have naked options trades in the trading account. It's unsafe to use 475 on the individual level because the IRS can say you're trying to use it on the options, but you got substantially identical positions in the stock. So they could apply 475 to your Tesla and Apple unrealized positions, dragging it into ordinary income mark to market. So if you have significant investments and only trade options around those positions, and that's all you do, TTS and 475 might be barking up the wrong tree unless you're prepared to ring fence your trading in an entity like an S Corp or a LLC partnership, where you do your trading in options and you have a few equities that you own for a month or two, so it's not naked options trading. That's all a trading business. It's completely separate from your major investment positions in Tesla, Microsoft, and Apple, where you might still trade options around, but that's all investing separate from trading. So in this year's guide, I've expanded on these concepts of investing versus trading and all the potential pitfalls and what you can do about it. Because I found with a lot of COVID traders, that's what they were doing. They were long some major big tech stocks and then trading the options around it and they were making a lot of money. And I've had a lot of consults with people and I tell them, listen, you don't have a lot of expenses. You can avoid wash sales with these following strategies. You have health and retirement in your job. Don't bark up the wrong tree for a trading business. Don't set aside 100 for an S Corp. It could be a major distraction. It could put you off your game. It just may not be for you. So I'm glad you brought that up, Sean. OVK, where can I watch the webinar? You'll have it on the Lightspeed site. Is the QBI still? Yes, QBI deduction is Tax Cuts and Jobs Act. It's absolutely still in effect. And the Build Back Better plan did not get rid of QBI. Didn't get rid of much. It still left EBL, NOL carry forwards. A lot of TCJA stays in place for traders, even with Build Back Better. But until you see the final, you don't know. There are some glitches, as always, come up last minute. Yes, your W-2 can offset your EBL, David. Sherry E. I'm almost done with the questions, Chris. Cash account, 25K. Yeah, that's enough for account size. So you may not, if you're a patent day trader, you need 25K. So if you go below it, you got to come up with some more cash. But I've seen people without PDT still trade enough for trader tax status without margin. You don't have to be a day trader. You could be a swing trader. Mike S., I set aside 30, lost it all. So without 475, you're going to have a capital loss limitation. Leo R, do you have to elect TTS? You don't elect TTS, you assess and claim TTS, but you elect 475. Don't conflate the two. So many people do. Get that all straightened out. Olvie again, submit 475. Then it's going to be the 3115. So Tracy, if without 475, you're using Schedule D and the capital loss limitation comes in. So I looked at the questions very quickly and I gave you basic answers to them. I think we're in good shape, Chris. So just to wrap up here, you come back on our site, you go over to the events. You saw today's event. You'll see the presentation slides. I'm going to update it with a few links. And the recording button will be here when I see that Lightspeed has a recording button up. So you go over to the Lightspeed site and that's where you'll see the recording. So again, folks, if you want the guide, you just come to the site and click on guide here on the right side here, and then go over to the new store. So you go to the guide, go over to the store, and then add to cart, add the coupon Lightspeed, apply the coupon, and you get your $17 off and you get that guide right away. I think that's what you need to do as a good first stop. So thank you very much to Lightspeed traders and to Chris and Rob. Great to work with you as always. And the CPAs over at Green, Neuschwander, and Manning, Darren Neuschwander, Adam Manning, they're ready to help you on tax compliance. Get in early because the door is open. We have the staff. You want to get on board with us early on. So if you think you need help, do that right away. Just click on back to the Green Trader Tax, Services, Tax Compliance, and stay on this page to see. Get that email over to Julie Cowan. She's fantastic. She'll get back to you right away. So thank you, everybody. Nice to meet those who I haven't met before.
Thank you very much for your time today, Robert. We really appreciate it. And thank you, everybody, for joining us this afternoon. Have a wonderful evening and have a great week. Stay safe, stay healthy, and get ready for tax season.